I think the biggest driver on oil and gas mergers is getting resource. Uh, we don't buy other companies generally to get their technology. We want the reserves and we want the drill sites. And in the mergers in the last couple of years, the cost per drill site has gone up to over $4 million per well. And so you have to pay that to get the drill site. Then you have to drill a $5 to $20 million well someday down the road. But nearly every company says we have 30 years of inventory of drill sites, and they really don't. It's more like 5, maybe 7. And anyway, they have to go buy other companies to get that. And so even with the VIX being crazy, if you're a healthy company and somebody with a lot of drill sites isn't, that's a pretty good target. Maybe you're gassier than oilier. That can work your way. The other thing we all tried to do was get scale. Wall Street gave up on $1 billion E&P companies. And I remember begging a Fidelity person once to buy our stock for an hour. And when I was done, they said, well, we can only own 2 stocks in E&P now, and that's Chevron and EOG. And I was like, well, thank you for not telling me that an hour ago. But, so we all started trying to combine to get to the magic $5 or $10 billion market cap number, which is now 10 billion or above. And that was the second biggest driver. I guess third was synergies, that if you can eliminate the wasted $15 million a year that you have on C-suites of small companies, that you can really do good. And so anyway, I'm still a little optimistic that there will be some deals done because healthy companies will try to buy inventory, drill site inventory, but we'll see. Because so much of that got done last year that it's hard to see who of the big companies is short now. It's probably the middle-sized companies, and they have to make the decision, do I try to get more inventory or do I try to sell to Exxon or Chevron or Conoco? And so that's an interesting dilemma.
And Chip, maybe I'll just touch on a couple of comments because people aren't familiar with this day-to-day. It is interesting in the energy industry, and it also tells a little bit what's going in the market. So if we go back earlier in my career and call it 15 years ago, being here in Houston, the energy industry was around 13 to 15% of the S&P 500. Enormous impact on what was going on in the S&P 500. Sadly, well, in a way, it's bittersweet, let's put it that way, is that today, the energy industry represents around plus or minus 4%. So it's gone from 14 to 4%, the S&P 500. Now, some of that is good because the S&P 500 has risen a lot, but it's risen a lot more than the energy stocks. And I think, as many of you all know, it's because really the rise of tech primarily. And we also know that if you looked over the last 12 to 18 months, there's 7 stocks in particular, the Magnificent Seven, that have really driven the market and much of the gains for the market. The problem is that what you want to get to high valuations, rather than just energy investors, you want to get the generalist investor pool, exactly what Chip was mentioning. And the challenge of the generalist investors is that your entire industry only represents 4% of the S&P 500. And, people don't like to hear this, but these are the facts, is that do you really matter? And then it gets into, well, how do you matter? And exactly what Chip was saying. In addition, for the drive of inventory is the drive for scale. It's also lower operating costs, but also you start to matter to generalist investors. And when you start to matter to generalist investors, you tend to trade at higher valuations and higher multiples. And what you'll see in many industries, not only the energy industry, there's a relatively high correlation between size, scale, and valuation. And the bigger companies trade, generally in higher multiples than the mid-sized to smaller companies. So in several industries, you're seeing this type of consolidation play out. Then it gets back to what I was talking about earlier, a lot of the discussion, which is regulatory. So then do you have regulatory authorities that are comfortable with basically consolidation of industries, which gets back to exactly what we've been talking, Lena Khan, the FTC, somewhat the Justice Department. Lena Khan was very, very negative on consolidation in many industries, particularly the tech, in addition to the energy. So that was this whole regulatory issue that people were very uncomfortable with. which hopefully is changing, but we don't know exactly yet.